Everyone, so welcome back to another video. In this video, we will be explaining the differences between the primary market and the secondary market. Now, this is really important to understand because securities are traded generally or most of the time often in two different markets. So it is not like the previous markets like we learned, like stock market, the bond market, the commodity market. In this example, it actually dives into the topic of where and how securities are being sold, from who to who, which parties are involved in the trade. So the key difference in the primary and the secondary market are who is involved in the market. It's not about what's being traded, because that was the previous video where I explained the different types of market for investments. Whereas primary and secondary market is sort of a conceptual understanding of how securities are being traded, from which party to which party, which person to which person. Now, we got to first understand what the primary market is. Now, as we learned before, as a general introduction and will be further elaborated on in the later videos on the stock market, the primary market is where securities like stocks or bonds, as an example, are issued for the first ever time. Now imagine, as we learn, a company will sell its ownership in the form of shares so that people, investors who buy the ownership, buy the shares, and in turn pay the companies money so that companies can raise money for operations, research and development, etc. Now, this is the first time, the first sale of the company issuing its shares. A company issues its shares through an IPO, which is an initial public offering. It is an example of a primary market transaction. Now, when a company first offers its shares to the public, it is done through this primary market. It is set by a fixed issue price, the fixed starting price, usually determined by an investment bank, set before trading. This is how a company goes public. Not every company is public. We can't trade the shares of every company in the world on the stock market. For companies, stocks to get traded on the stock market, like Apple, like Google, etc., they have to go public. This process of an IPO makes their shares and gives a process for the company to sell its shares, to sell its ownership into the public. Now, I wrote here it involves a bidding process. In the primary market, investors will bid to gain the first round of shares. Now, it is important that we understand the distinction. In the primary market is the first time in which the company sells its shares. When we trade on the stock exchange, it is known as a secondary market. So the secondary market is what we usually call as the stock market, the stock exchange market. Now, going back to just the primary market, just a bit of more elaboration, it sort of gives up ownership of the company gives up its ownership, in which the public buys in the form of shares to raise money. Now, we got to understand that this is the first time the company lists its shares, the first ever time, the first time it goes public, giving up the shares for public buying so that the public can pay the company, so that the company can raise money. Now, what's the difference between the primary and the secondary market? Now, the secondary market is where the securities are traded after they've been issued. So as I mentioned, trading on the KLSE, the Kuala Lumpur Stock Exchange, trading on the New York Stock Exchange as an example. We do this between traders. We buy from other traders, we buy from the supply of stock and the supply of shares or bonds that are already in the market. So think of it as the resale market. Investors will trade among themselves. Let's say I am investor A. I went through the primary market and got the first ever round of shares from, let's say, Apple. Now I sell my Apple share to the next person, investor B. So this market where I sell to another investor is known as a secondary market. Whereas the primary market is when a company gives up the shares directly, issues the shares for the first ever time. We've got to understand that it's the first ever time that the company sells the shares and investors buy. So the shares go from company to investor. That's the primary. And the secondary is when it goes from investor to investor, sort of a resale. I own this product, I buy it, I sell it straight to another investor. So imagine it like this: primary market, I buy directly from the factory. And the secondary market is where I take the goods I buy and I resell it to other people. So this is how it works. The primary market is of a less common thing because not every day shares are being issued, but every day transactions take place in the secondary market. Bonds, bonds, stocks, commodities. Every time that the trade or the security is being retraded or resold, it is in the secondary market. And as we learned before, the primary market price is determined by determined by a fixed issue price, whereas in the secondary market is determined by supply and demand. If the demand for the stock or the security increases, that means there'll be less supply of it left, more people will buy it, and then therefore the price of the stock will go up. Vice versa, if more people sell, increasing the available supply of the stock, so it is in less demand, the stock price will fall. Now here are some of the key summaries, and it's really important to understand the key differences. See, primary market is the market in which new securities are issued for the first time, and the issuer, so the firm or the government, sells the securities directly to investors, direct trade. Whereas in the secondary market, it is the market where previously issued securities are traded, so old securities in which investors buy and sell among themselves. Take a look at this summary table, and thank you for listening.